welcome to the Future's Edge podcast. I'm Jim Uriel with the brains behind the operation, Bob Acino. Bobby, how are you?
Good to be here, buddy.
Good. This was an interesting week, particularly the last 2 days with some strength in the stock market. The general prevailing theme is that perhaps the Fed isn't going to tighten as much as they kept telling us they were for the last couple of months. What clues has been given to that? What do you think of that?
So it's interesting. We do a live stream every day, Path Trading Partners. It's actually the same YouTube channel that we distribute the show on, along with Spotify, which we don't do. Just this show is on Spotify. But on those live streams, I've been talking about my theory of how the Fed's going to get out of this mess, not without pain, but with no blame, right?
I'm blaming already, by the way, just to be clear. But yeah,
you've been blaming. I mean, in fairness, you've been blaming for a long time. Your Twitter is peppered with inflation was deliberate. Always remember that. Because they said it. We need inflation, right?
Amen.
It's like be careful what you wish for, kind of a thing.
Amen. Yeah.
My theory's been they're going to do the 50 basis point hikes, the three that they're talking about, and then stop and say the supply chain has to do its work now. Like we have to get the supply chain back. And that's not going to be enough. It's certainly not going to get us to 2%, which is what their target theoretically is. So the theme now, I think, I mean, I've had a couple of people say it to me, is they're for sure doing the 50 in June. But given some of the slowing in the data we've seen, do they do 50 in July? I mean, maybe they do 25 in July and back off, but definitely, as you mentioned, the theme is that they're going to back off much sooner than people were talking about it, let's say even a month ago.
So here's something that's so interesting about this equation, interesting and potentially destructive and toxic too, which kind of go hand in hand in this situation, is that they raise rates to start to call demand, to try to get demand into balance with supply, which means they're actually forcing the economy to slow down. So whether or not they forced it into recession, that you can debate about that all you want, but it is an absolute fact, undisputed, that by draining liquidity out of the system, by raising rates, by stopping to buy bonds, they are trying to slow down the economy because that the demand is outstripping supply. And that's why we have the massive inflation. Yeah, just by the way, today, those PCE numbers with 6.3, less than people thought, which I guess was encouraging, but still, basically record highs. But the point is that the point I'm trying to make is that if you kill demand, if you stomp it like a bug, then there's really no force pulling supply through. So perhaps they're going to have to put up with, hopefully not 8% inflation, but perhaps put up with a little bit of inflation, because if they kill demand, there's not as much incentive to cure the supply chain. If demand is still there trying to go after those products, then it's still there. Do you think, is that the way they look at it? That's the only way to look at it, right?
It's really the only way to look at it. I think that's the last part of your statement is like, who could dispute that? How do you look at it any other way when you consider that they can't really control some of the major factors in this particular bout of inflation? The supply chain, they can't do anything about it. The only thing they can do is slow down demand. And yeah, we had an excess of demand based off of people coming out of the pandemic and going absolutely nuts with free money that was given to them by the government. But an interesting part is the stimulus checks that were given out, some were spent and some were saved. And we saw a savings rate ramp up in the US, which we haven't seen for a while. And that savings rate is still at high numbers. But, and this, I'm stealing this from our friend Cameron Dawson, who's more my friend than yours, but
she's so good, by the way.
She's so good, dude. Did you see her recent note?
No. Send it to me.
I'll send it to you. It's 32 pages of just brilliance. But she talked about how the bottom end of the socioeconomic curve is saving less. They're starting to dip into those savings. And that's the way the saving rate kind of ebbs and flows. And it makes sense logically, right? People who are more check to check that save their government stimulus checks now needed to dip into that to deal with inflation, and their savings rate is going down. But the overall savings rate is still relatively high because of the middle, the upper middle, and the wealthy who have massive amounts of savings still. So again, as happens when politics gets involved with economics, the lower end suffers more than the higher end. People blame that kind of stuff on on capitalism. It's not. It's interference with capitalism that causes that to happen.
Oh, there's no question about it. And when you talk about income inequality in this country, which is great, I mean, technology belongs in there, but there's some other things too, not the least of which is the government trying to fix inequality. When they keep rates inorganically low, they fuel this bubble bust sort of thing that's gone on for the last 30 years. And then they sit around going, gosh, what should we do to help? What you could do to help is stop helping. If rates went, if you allowed, and I genuinely believe, and I don't know if you saw me, I wrote a little bit about this yesterday, is that the Fed exists now to be the bumper rails or the training wheels for a government that the economy really can't get going based on punitive taxes, punitive regulation, not just at the federal level, at the state, county, municipal level too. I know this firsthand with the restaurant. I want to get into restaurant discussion a little bit too. But so the Fed has to keep rates inorganically low, which fuels bubble bust, which makes assets that rich people hold go higher, including the bond, not just houses and stocks. And it makes the things that the poor people need to buy, food and energy, go higher. Granted, we didn't see that in earnest until the last couple of years, but it was always going to happen. It just boggles the mind, doesn't it?
Yeah, it really does. And that's why I think that, you're talking about politicians. If somebody says to me, these are not dumb people, I disagree. But when you're talking about people like Jerome Powell, who actually spend time in the private sector, he's not a dumb person. And he's just in a situation, and I'm not saying it's nefarious or not nefarious. I'm just saying he's in such a situation that he had to wait to get nominated and confirmed to do what he really thought he should do. Now, he could have just said, look, this is what I'm doing, nominate me or not. That would have been the courageous thing to do, I think. And I'm not saying he's not courageous. He certainly doesn't seem courageous to me, but he's certainly not dumb. And when I look at it and say, okay, he got himself confirmed, renominated, then confirmed. Now he sits down and says, okay, what, if anything, can I do about this? And what you described a few minutes earlier is all he can do.
Right. So to put what Bobby just said in perspective too, after he got renominated was when the first time he decided to actually talk about being hawkish, and then after he got his final confirmation, the next day was when he started saying, yes, soft landing might not actually happen. It might be, we might be coming in a little hot. So to think that he's not politically motivated is asinine. And I've gotten arguments with people too who are like, well, he's already rich. Why does he need this job? I don't know. But I know it seems like from the evidence we've seen that he's clearly politically motivated. Maybe he likes the power. Who cares? Maybe he doesn't like to fail and doesn't like to be fired. And he may have been fired. I hit upon restaurants a second ago. And within that PCE, well, the inflation data that came out today, there's some interesting things. Number still 54% of the money spent on food is spent at restaurants. The first, I don't know if you know this, me being in the restaurant business and you having a family in the restaurant business, you probably do. In 2015 or 16 was the first time probably in the history of man on this planet that people spend more money at restaurants than they did at the grocery store for food. That's increased. Right now, despite the fact that prices are going through the roof, people are still going out to eat at restaurants. My theory, and I was just talking to our mutual friend Scott Shelley and his show out of Nashville about that, I believe that the whole paradigm has shifted, is that after being bottled up for a year and a half, some people for 2 years, that we are social animals. People feel that going out, dining with people, being near people is now a emotional necessity to them, and they're willing to part with more money, despite the fact that it's getting nasty expensive. Do you like that theory?
Yeah, I agree 100%. So my family in the restaurant business, we've been in it. Well, I left it in about 92, but my family was in the restaurant supply and then the restaurant industry my whole life. The difference between your restaurant and say my brother's is a lot of my brother's business is carry out. The majority of it is still carry out. And he does a lot of catering for parties and car dealerships and things like that. His sit down business is very small. He thrived during the second half of the pandemic, right? When he was able to readjust his business model and say, okay, people are going to be picking up food outside. I need to cut labor a little bit. I need to reduce my menu, blah, blah, blah. And all of a sudden he said, wow, I'm making more money than I've made in the last 10 years on a year-on-year basis. Now we come back to where people are actually sitting out. He's always closed at 6 o'clock. So he's never had any dinner business, but his sit down lunch business is thriving. His takeout business at night has suffered. And that's because people are socializing. So it literally plays right into your theory.
Yeah, and it's funny that when you talk about the restaurant industry too, is that the restaurant industry threw a lot of money in, and I sat down with my partner at the beginning of this whole thing, and I said, realistically, when something like this happens, a shock, a chaotic shock like this, good and successful restaurants are probably going to end up doing great. Middle of the road, bad restaurants are going to probably be knocked out of the game. Now, people might listen to me say that and say, like, well, fine, they're not. No, it's not fine. The market should decide that over time, and perhaps many of those restaurants, given more of an opportunity and a chance, would have developed into something. So the whole thing has been great for my restaurant. My restaurant's been there since 1931. People go to my restaurant to feel normal. What lacked in the whole last 2 years was a feeling of normalcy, and so we've thrived. Sounds like your guys thrive too. It's just amazing how it happened, and again, it underscores the point that when there's chaos, the rich get richer and the poor get poorer. So if you want to fight inequality, we just cannot have these ridiculous economic shocks too. That goes to the education portion of this too. It is absolutely settled science that the poor neighborhoods, minority neighborhoods, did not do as well with remote learning in schools. When the government gets involved, that's what kind of crap happens, right?
You mentioned the education part of it. I followed you on Scott's show today. So literally, Scott actually mentioned something you said during an interview that was prior to mine. So he said, oh, this is just like what Jimmy said. So I know that's you. Him and I were talking about student loan forgiveness and some of the other jobs people can get without going into debt. And the interesting part about government manipulation of systems in general is this idea that they're going to forgive came out in the Washington Post this morning. And just for reference sake, it's the Friday before Memorial Day. So Jimmy and I are doing a shorter show, and we didn't want to bother any guests before the holiday. So it allows us to spew on other topics a little bit. The student loan thing, the $10,000 story that came out in the Washington Post this morning, applies to about 40% of the people with student loans that have less than $25,000 of student loan debt. It's a big number of people that would get relief from this plan. But what it does in my mind, as I look forward, if this were to become more of a standard thing, a starting average salary of a chemical engineer is about $73,000. The average starting salary for a truck driver in the United States, according to Indeed.com, as of May 12, 2022, is $78,000. Now, if I'm a father of somebody who's about to go into school, by the way, the median salary for a chemical engineer 10 years later only rises about 23%. So they only get to about 106,000, right? I don't know what a truck driver gets to, but I know he gets to retirement because he starts that job 4 to 5 years earlier than a chemical engineer does. And they've got benefits as well. They've got 401k, they've got healthcare. And if I'm the father of a college age student right now, I say, look, why don't you go for a year, rack up about $10,000 debt, we'll get that forgiven, and then you could start driving a truck at Walmart, which, by the way, starts at $85,000 a year. $85,000 a year is a 20-year-old.
I would have been in a lot of trouble if I had money as a 20-year-old. I would have had a lot of trouble.
Living at home, a lot of them still. Yeah. I mean, it's a crazy amount of money if the kids have guidance as to what to do with it.
Sure, and the whole paradigm is ridiculous. When my plumber walks into the bar I own, his name's Kurt Redke, I buy him a beer. He's my freaking hero. And he has one of the nicer houses. He has plumbers who work for him. We, for the last 40 years, acted like raising our young men to be tradesmen was somehow like an insult and they can do better than that. When realistically, the plumber, you only need a plumber on Christmas Eve when some pipe broke. He literally comes in to save the day. He might as well be wearing a cape. And yet we, for years, have treated them like they were a low rung of society, despite the fact that they made more than us and they did more good. Why in the world wouldn't we have pushed our kids to be tradesmen more? I can't even work a hammer. Do you call work at a hammer? I don't know. What do you do? Hitting things with the hammer.
Yeah, you hit things with a hammer. I don't know.
That's what I thought. Me neither, right?
Plus, by the way, they do a lot of things to their houses that you have to pay people for.
Oh, no.
So they literally, there's a guy down the street from me. He's a retired, I believe he's a plumber as well from Philadelphia, right? It's the same house as me, except when you go in, he's got all kinds of custom things that he did inside the house. I'm like, who'd you get to do that? He goes, you're looking at him. Cost him nothing. He just did all the stuff himself. He's got a water feature in his pool in his backyard that he put together and built. It's amazing. It's an amazing life is my point.
Yeah.
So, this whole thing of the education side of things, the ROI on college education is dropping like a rock unless you have a very specific skill set, a very specific degrees. And the entire system is turned into a form of when people tell me, this has been the excuse when socialists have talked about this before. It's like, show me where socialism has actually worked. And they'll go, well, that's not real socialism. Anywhere it hasn't worked, which is everywhere, right? Which is everywhere it's ever been tried. And now people are like, capitalism, this, capitalism, that. I'm like, we are not in a capitalist society right now
No,
by any
not at
stretch.
all.
So
Yeah.
you know what one of the most capitalist things we still have is the markets. So I want to ask you a question, my friend, because I'm the co-host, so you're my guest and I'm your guest.
Damn straight.
Bottom in the equities is the bottom in. Again, we're
Okay.
recording. It's a half day today. Was it a half day today? It's a half day in
Yeah.
the futures.
But
So,
no, the stocks are still open. Yeah.
okay, so it's Friday, the 27th, before Memorial Day. We got Monday closed bonds and equities. Do we put in a bottom or no?
Okay. I think there is about a 30 to 40% chance that we did. For 3 months,
Good.
the beginning with this started, I kept saying, and there's video evidence of this, I believed we need a minimum of 20% correction in the S&P. It's just a reval based on rates reevaluating. A couple things have changed. First, from a fundamental standpoint, as we hit before, the Fed we anticipate them to start talking a lot less hawkishly in the next couple days. We anticipate them to perhaps, I think, 2 more 50 basis point hikes and then a pause to see if perhaps they're in the neutral rate. And I do the quotation marks.
Before you go on, do we have evidence of them doing that, or are you and I just speculating basically the same thing?
Well, Raphael Bostic last week in the Atlanta Fed president, non-voting member, but at a planned event said, perhaps, I think she said perhaps after in September, we will sit back and see and look to see where things are.
Right.
Now, here's what's interesting about that to me is that hell yes, they should be doing that at every moment they should be doing that. And it's just part of the whole, being nimble, responding to the data thing. But the fact that he said it at a planned event, to me, I think means he was wound up, go out there and say this and try to plant the first seed. So to answer your question, there has been scant evidence, but not no evidence that I believe they are changing mentally. Make sense?
It does. It really does. From my perspective, I've been telling, again, the people who watch our live stream and the people that watch this podcast, that my prediction was a medium-term bottom was coming soon, and I wasn't willing to predict when it was. 2 days ago on our live stream, I said it's starting to feel like the medium-term bottom has happened based off of price action. I mean, it just seemed like there was a floor. You would see the equities go down and rally up into the close, maybe not turn positive, but still rally up. There are a couple of days where we turned positive. That's what a bottom feels like, right? But I call it medium term because I think they're going to do exactly what you just said, and they're going to be wrong. Earnings are going to suffer because they've already done enough. And by the way, I shouldn't say them, but with 2 more 50 basis point rate hikes coming as late as they've come, I am a firm believer we're going into recession. I'll disagree with our friend Ryan Dietrich, who was on a couple of weeks ago on our show, who tweeted out the other day, I can't see a recession with retail sales this strong and employment this strong. Retail sales, inflation adjusted, were negative, and employment lags by about 6 months.
Yeah, no, I'm with you on the recession thesis too. I think that when we look at the recession after the real estate bubble collapse, the recession after the tech bubble collapse, I think there was massive built up leverage. Let's take a look at the real estate bubble first. Is that anecdotally, you would sit at the table and talk to some guy who was a plumber. Well, no, let's not talk about plumber. Plumber's a star in my opinion. Someone who, whatever kind of job he was, and had 5 homes that he was rehabbing and flipping. Right. I see plenty of people who have 2 homes. I don't see a lot of people who took the bait on this last couple of years and bought a crap ton of homes. I do see that 18 to 20% of the new homes bought in the last 2 years were bought by corporate investment interests, and BlackRock responds to a margin call different than Bobby Iacchino or Jim Uriel responds to a margin call. So I don't think it's going to be any sort of like, oh my God, what just happened, collapse of our economy. I do think we're heading into a bit of a recession too. That being said, if we head into a bit of recession, that doesn't necessarily mean the stocks have to crumble. The stocks could have already maybe flashed that recession with the 20 /31% loss in the NASDAQ. So that's why I'm encouraged as well. Now let's get to the technical part of it too. We had a higher weekly. We're going to have a higher weekly close today. I know we're still an hour away, but unless things get knocked to pieces, let's see. Yeah, we're still relatively strong. That 4,100 level in the S&P was a good level. If I see strength on Monday and Tuesday above where we closed today, I will be about 60% sure that we've hit the bottom for now. And again, we have a lot. People say the bear market, and you've said it yourself. It's the bear market's not over until we make new all-time highs. That's fine. There's a lot of room between here and the all-time highs for people to make money. And we'll cross that bridge when we get to it. Can I get to my ES trade now, you think?
Yeah, shoot.
Because it fits right in. Okay, and I put on something similar to this using options. And this is, again, one of the beauties of the micros is that you can put on a broad trade and not have to worry about minute to minute noise. Now, this is a pretty broad trade. So it's buying the June micro E-mini S&P, micro S&P at 41.10. Now we're a little bit above that now. I think you could go up a little higher too, although I do expect hopefully a little bit of a pullback to where we broke out of this from, and that was 4,100. Buy it there. Target of 42.90 on the upside. You remember we talked about that 4,300 level a couple of weeks ago when we had Mike Arnold on the show, who's a brilliant technician. We talked about that level and how significant it was. A stop on the downside of 39.90. Now, if this trade, if you reach your target, you make $900 on the upside, and if you get stopped out, you lose $600. Again, by the way, this trade can be made, and still you can think to yourself that we might still be in a bear market. It might be a bear market rip or rally. Thoughts?
Yeah, I love it. If you look at the ES, if we close, actually, this will reference back to what Mike Arnold said on that show. And if you guys didn't watch that show, you still can, because he does an entire month. We're going to have him on the first Friday of every month. And he was spot on about this. If we close above 40.95, that triggers a double bottom. Okay. And it's a technically correct double bottom. And on that technically correct double bottom, my first target on that is 43.18. I'm going to go a little bit lower because the May 5th highs came in right around 4,300. So I'll do 4,300, but that plays into your trade perfectly. I think it's an excellent trade. And I think it has a very high probability of working. And because I didn't say 100% chance of working, the risk reward is what you look at it. It's got very good risk reward.
Okay, good. And okay, if you go back to our show a week ago, we talked about interest rates, and I gave a trade that's working now in the 10-year. I'm not as much going to talk about my trade in the Canadian dollar, which seemed great for a couple of days. Which, by the way, actually, let's hit that. As long as we're talking about trading right now.
Yeah, let's talk about that.
The Canadian dollar trade, I had 40 ticks in on it. I ended up losing money and reversing it at my stop out level. Now I've made some money on the upside then too. But so what do you think? Like that trade you had 40 ticks in it. Do you move your stop to break even? You don't, right? You just leave your parameters the way they were, correct?
So I always work with a target, and you always give us a target on this show. One thing I like to tell people is a target is a place where an action is needed. It doesn't necessarily mean you cover the trade. Okay. So what I do, for example, I said that I'm going to hit that if I were to go long ES. I didn't. I'm just looking at that now, and maybe I will before the market closes, because we're going to close above a significant double top or double bottom trigger. But having said that, the first target for me on that particular double on the ES, for example, would be a place to move a stop, simply because I've got another target even higher than that. So if I've got a multiple target trade, I will move a stop at a target. I also have some momentum indicators, and if I see the momentum building as we move to my target, rather than exit, I will trail a stop. So it really depends on the trade. So yes, I'll do that in a lot of things. And actually, I've done it in the crude oil trade from last week. I've moved my stop higher, but in the same time I've done that, I've also added to it in options. So that's another thing I'll do is I'll add to it in options. The options trade's already working, and then I'll tighten up my stop, because now that I know I have a more exaggerated position, I don't want the loss to exceed what my original loss was in the first place. So that's another time when I'll do it. I've added to the trade. Well, I don't want to increase my losses, because the desired risk at the beginning of the trade never changes for me. That's the
Can
one
you
thing that never changes.
can you go in to what your trade was from last week and
Yeah.
then why you, and can you tell, I'm putting my feet way up here. Is that okay? Do I look like
Yeah.
think I'm Mr. Cool Guy, just too relaxed here?
You just
'Cause
look relaxed. I mean, you got a
okay,
long
good.
weekend coming up.
Damn straight. Can you go into it?
Yeah. So I bought a micro crude at 190.60. I'm sorry, 109.60. Okay. That was a micro crude trade. My stop was going to be all the way down to 102.59, which we didn't get anywhere near that. As a matter of fact, after getting in this trade, we pretty much went, I don't want to say straight up because it wasn't an aggressive move like you're used to seeing in crude oil, but it never got anywhere near giving me any indication that we were going to go down 7 handles on this thing to get near my stop. And my target on this one was 123.70. That's a Mike Arnold level, by the way. So for this particular trade, we're now trading about 114 and change. Last I looked, I think we're about 114.33 or something. So I'm in that at 109.60. It's a pretty profitable trade at this point. The potential profit on this was 1,400 and the potential risk was 701. So I'm about a quarter, a little bit more than that, almost halfway to the target now. So I saw momentum gaining based off of an indicator. Now the volume is not there to confirm that for me. The volume's actually been declining in crude oil. The volume has been high on the downside, low on the upside, which is not it doesn't make you very comfortable, right? But we're getting close to closing above a horizontal channel. As a matter of fact, if you'll allow me, I'm going to share my screen real quick.
We are going high tech here, brothers.
We are going high tech. All right, let me pull up my chart really quick on a screen share. All right, tell me when you're seeing it.
I do not.
Okay, let me see what's going on here. It says I'm sharing it, but you're not seeing it.
I see it.
Oh, you're seeing it. Okay, good.
Yeah, it's great. Yeah.
You move us the other way here. So what I've got here is.
Did you turn the recording back on?
I did, yes.
Okay, good.
All right, so now I better check just to make sure. I think I did. All right, Nader, edit all this garbage out.
I like the garbage. I think it can stay.
Nader, leave all this garbage in. I did. I know I did. I can't find it now, but I know I did.
Okay.
Yeah, I did. Okay, so what we've got here is a crude oil daily chart. And you can clearly see two things going on. Here's the recent price action. Let me drag it this way a little bit. These red lines right here are the horizontal channel that we're currently in, okay? The blue lines represent the upward sloping channel that we've recently created. Now, it was a lower trend line anyway, right? But then right around here at about April 18th or so, we started to run within this channel, but still within the bigger horizontal channel, right? So my trade was going back into this little rotation zone, which is made up of these two moving averages. And you can see they're starting to widen and angle up. And when that happens, I will take a trade into that rotation zone. You can see I could have gone as low as 108.64, but I bought really at 109.60. And then these 2 days happened, right? We kind of moved up and ramped up in here. Now, what I did when I bought here and I saw this move come in is I went into the options. I said, I'm going to add to this. So I've since actually moved my stop from this level of 102.59 up to where you see this red line right here, which is about 108.54 or 108. I'll tell you exactly what it is. I don't want to open up my system here. It is at 108.49. So my stop's around 108.40 now. So it's a little bit below this peak here and a little bit below this little cluster of lows here. And when I did that, I've drastically reduced my risk on the trade from the $700 range to about the $300 range. So now I have more risk. So what I did was I bought the 114 calls and I paid $320 for those. Now on the standard options, that's basically, it's 3,200 or 320 on the micro options, I should say, would be $320. On the standards, 3,200, right? So these particular calls is what I'm going to hold if we get to my target on the futures trade. Okay. So we get to the
Yeah.
target on the futures trade. I'm going to cover that and I'm going to hold the options either till expiration or until crude oil decides it's going to make a move lower or until we just don't get anywhere near. I'm already in the money on them because they're 114s. So now they basically act like another future, right? Delta's somewhere around, what would it be? Around 90 at least.
Yeah, right.
So now they
What is the expiration?
it's the third week of June.
Okay. Yeah.
So I'm in the money in the third week of June. These are basically a futures now.
Right.
That's
Yeah,
a futures
yeah.
contract. So
Everything.
that's what I did on this particular trade. So the crude oil trade is working. I obviously needed to extend, but I've already cut my risk in half on this. And I did this in part because of the support here and because the rotation zone, because it's moving average, they're moving average based, are moving higher. So it ends up being kind of a dynamic stop level for me.
I like it a lot.
Yeah. So
No,
that's
that makes a
basically
ton
what
of
I
sense
did.
to me. Yeah.
Now
I
I want
like
to point one more thing out, and this is again, not stolen from Mike Arnold because we work together, but if I put these harmonics in place, right? Notice right here is the 75% level, which comes in at about 121.11. It's right below where I had labeled my target. So I'll change my target to 121.11 based on Mike's harmonics, because if I can get a close above this 114.93 level,
Yeah.
that has a very high probability, higher than 70% of hitting the 75. So that's where I'll now exit the future, knowing that I've got the calls in place to continue a move higher if it happens.
I like that a lot. Wow, that's a good trade. And again, I love using options. I prefer using options. I prefer the 100% defined risk. But I mean, I use futures quite a bit too. I want to move to rates for a second, because when we were talking a week ago, I thought rates were going lower, but I didn't know why I thought rates were going lower, because the technicals of it were pointing to that, but still the story hadn't really changed. And then early in this week is when that big day came where essentially the Fed funds market had been pricing in a 40% chance that by July of 2023, Fed funds rate would be 3.5 or higher. Basically, in 1 or 2 days, they took that almost all the way out. Now it's like a 4% chance that that'll happen. But anyway, this was last Friday when I talked about this trade. So it's funny to me, and I know it's interesting to you too, how the market started to move before the story started to unfold. And that's why we're technical traders more, because we'll find the story. As long as the fundamental story that I'm seeing at the moment doesn't 100% conflict what I'm trying to do, then the technicals are more important, right?
Yeah, I mean, price action essentially, I said this is going to sound weird, but I like the analogy. Price action is like tight clothing, right? Of which
you know more about tight clothing than anybody.
I wear a lot of tight clothing as a member, as an official member of Eagle Fang Karate. You can see what's underneath it by looking at the clothing. You almost don't have to see the clothing come off. That's a weird analogy, but it really works.
I kind of like it. If we were
fundamental
drunk,
analysis,
fabulous.
Fundamental analysis is like loose clothing. Okay, you get kind of an idea what's going on, right? But you can't really see. Now, the reason I use that analogy is you and I both in private conversations said the same thing, sometimes using different words. I think this is what the market is going to think coming soon. But we have no idea if we pull that out of our asses or if that particular narrative is going to grab hold of the market, because at the end of the day, market pricing is mob rule, right? I mean, if enough people believe a narrative, it's going to trade that way, whether that narrative is correct or not. We see that in stocks all the time with some of these high flyers that people just get out of their minds about, and then they end up buying a gold mining company instead of actually doing movies. These kinds of things happen all the time. You might know what I'm talking about.
I do know what you're talking about. But
so, from a perspective of that, that's why fundamentals are not a good way for an individual to trade. They're really not, because the only thing you know with 100% certainty that is true is that crude oil traded through 114 today. You know that's true. It is not false. It's not opinion. It's not speculation. It happened. So if you can base your trading off of things that you know to be true, you have a much better chance of finding a method that's going to work for you. Now, your price action could back up your fundamentals. And this is why I work so closely with Mike Arnold, because I'll have an idea And he'll just go, no, absolutely not. Not now, not yet. He won't tell me it's wrong. He'll just tell me I can't do it. If I showed you a Chipotle chart, I'll show you all the places I told him I wanted to buy Chipotle after the scare. After, I don't even remember what the scare was. It was foodborne illness, right? And it just kept, I want to buy it. I see lines at the restaurant. No, 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 no. One day, Mike Arnold called me. He's like, you still want to buy Chipotle? I'm like, well, not really. I haven't looked at it in a while. A couple of weeks later, I look, boom, it's gone.
That's hysterical. And that's true. And I love that. And again, I'll put a finer point on what you said is what Eugene Fama won a Nobel Prize for like efficient market theory, meaning that at any one moment in time, a heavily traded market knows everything. So that's why if you're sitting in front of your computer and you see a fundamental story, you think you're the first person who noticed that fundamental story. No, you're not at all. That's why price action is much more important. Again, I like fundamental analysis. I'm not dogging it. For me, it's about 35% of my decision making, but price is much more important. But anyway, on to the.
It's where we get a lot of our ideas is from fundamental analysis.
And then we go look at the chart.
Then we go look at the chart.
Yeah, absolutely.
So it's critical.
Yeah, it's critical. Absolutely. That's a good point. That's a great point because I didn't think it that way. And that's the way I do it all the time. I get that. And by the way, there's a guy who's on Twitter, and I'm going to mention his name. It's Keith Kern. K Kern is his Twitter handle. And he posts some on the upside with some great charts on stocks, individual stocks, which we're not talking about here. And I won't mention any time. We're talking about futures here, but some great charts. And some of those individual stocks seem to deal with technicals even better than the big broad markets, I think. And that guy's made me a lot of money. I owe him, and maybe we should have to get him on this show one time and talk about and see if he can do futures with his charts. But anyway, so rewind to a week ago where I wanted to sell the 10-year. I didn't actually make this trade in the name of full transparency. That's just because I got so many things on my board and I got my client business that I forgot to make it. And this is the trade that I will make again. If it gets there. Where are we right now in the 10-year? The June micro 10-year yield contract is trading about 273. I need to see a little bit lower because it's a stop in trade. We've talked about this before. We've gone over and over about price being the indicator. So sometimes price has to break through a level of support for me to think it's going to accelerate from there. It's somewhat counterintuitive for people to think I want to sell it at a lower price than it is now, but that's sometimes the way we do it. So I think 2.72 spot is a point to sell the June micro yield contract. And again, it's the same target as last week when I talked about selling it at 283, which is 2.5. 2.5 is a nice psychological level. And again, as Bobby said before, as it gets close, you can reevaluate it, go do a deeper dive into the technicals. But some of those big round numbers in 10-year tend to have some magnetic power. The stop for this one for me is 290, 2.91 above. So that trade makes $220 if you hit your target, loses 190 if you're stopped out at your level per one lot in the June micro 10-year. Thoughts?
10-year is closing at a lowest level since like early April. I'm looking at it right now. We had a 242 settlement on April 4th. We had a 274 settlement on April 15th. I like looking at the settlements on the yields. And the fact that we settled, well, we're not settled yet, I guess, but the fact that we look like we're going to settle below 2.25 on this one, I like it. And I think 250 is a really good level because psychological levels and yields to me work better than any other product.
I don't know why. You know, it's funny. I thought that exact same thing, and I don't even know why. It's just because we've been around too long, right? And then we've seen. I guess
because my first Fed rate hike ever, or rate cut ever, was 25 basis points. My first rate hike in my career was 25 basis points. They just like these chunks of 25 for some reason.
So maybe that's where it reverberates from. They go 25s and 50s. They go round numbers in the short part of the curve, and maybe that just reverberates psychologically through the rest of the curve. I don't know why, but I agree with you 100%.
Yeah, the only place you see those weird yields are in actual bonds. Like you can go buy a corporate bond, it'll have a 4.18, coupon on it. And that's basically because the company's trying to squeeze that very last dime that they can, which makes sense.
Damn straight. Yeah,
damn straight.
Right. Tell me about your weekend. What are you doing?
We've got friends in town, actually. They are landing in about 30 minutes and staying over at the Ritz here in Naples. So I'm going to actually.
Which Ritz? The one on the beach?
No, the
which race?
Tiburon, the one on the beach was all booked up, which you
Oh,
can't believe.
nice.
I mean, you want to talk about a high-end consumer. The Ritz on the beach has been booked up for as long as I can remember, and it's $1,600 a night. I
That's
mean,
a
it's just
great spot, though,
insane.
isn't it?
Oh, it's a great
Yeah.
spot, but it's just
Yeah.
insane.
Yeah.
Here's the thing.
You
So
want to
this
talk more about markets?
no, I'm not. I'm actually done. There's two things I wanted to point out today. And this actually, I love this quote because it applies to politics. It applies to what we just talked about on fundamentals versus technicals. Okay. And it also a little bit for me applies to life in general. And it's a Thomas Sowell quote, which he's my favorite economic author by far.
Without any doubt,
Yeah.
by far my favorite. Anyway, yeah.
I read a Milton Friedman book, and I wish I could have seen Milton Friedman speak because I think he was a more entertaining speaker than Sowell, but I think Sowell's a better writer. Thomas Sowell writes, some things are believed because they are demonstrably true, but many other things are believed simply because they have been asserted repeatedly and repetition has been accepted as a substitute for evidence. This happens in the markets all the time. When you hear people buying something, you're saying, this is what's happening. I know this is happening. This is going to happen. And they get other people on the bandwagon. And then eventually the truth comes out and that particular trade doesn't work. And usually the early people, see it's in penny stocks a lot, the early people are out and the other people are left holding the bag. And we see this in markets all the time, but it's in politics more than anywhere, right?
No doubt
Some things
about
are
it.
facts because they're demonstrably true by evidence. Other things are just repeated.
No doubt about it. So funny because it reminds me of, let's just say a random television station that I may have done some things for in the past, who tends to pump things up. And I remember one of, I'll tell a couple of little things. I don't know what television station that is.
I don't either.
But I remember an executive producer saying to me, no, just because something is true doesn't mean you can say it. And I said, no, it does. I said, it does mean I can say it. And I can say it loud and repeatedly. And I did say this also. And I said, I'm not saying my integrity is not for sale. I'm just saying you're 2 zeros too short. Now, I thought that was funny. They
By the way,
think it was
that's
funny.
also demonstrably true.
Demonstrably true.
Right.
I'm expensive.
You're
but
expensive,
I'm for sale.
but you'll do it. The other thing I want to do, because we're filming before Memorial Day, I don't know when this is going to be out. It may be out on Memorial Day, it may be out on Tuesday, but I wished somebody a happy Memorial Day earlier today. And this particular person,
you got yelled at,
corrected me and said that it's not really happy if you think about it. And he said, I just tell me to enjoy the long weekend and to raise a glass to all the people this day is particularly supposed to be about. So I'm going to go with that at the end of this.
Yeah,
podcast.
I love it.
I'm going to just
By the way, that flip off, it was a joke. It's not for Memorial Day at all. It was the person who chooses to correct people all the time. When
that's also, I think you know who the guy was.
So. Oh, I know for sure, and I love him. Love
Yeah.
him. He's a friend. Yeah.
But anyway,
Yeah.
I want to.
I do want you to have a happy weekend and give. I'm from a military family. I nobody died in battle, but it's a serious thing to me. But I do intend on having a happy weekend. Full transparency.
Yeah, I have a friend who's in Iraq right now, so he's on my mind. And again, anybody knows military families or anything from both of us, I want to say, have a good long weekend, and we'll be raising a glass. And if you pray, say a prayer as well. I don't do that much.
Amen, brother. All right, have a great weekend. Okay.
Cheers, brother.
See you, my friend.